They changed the rules on your property taxes by age, and they didn't send you a letter. They didn't run a press conference. They didn't interrupt your evening news broadcast to make sure you understood what had just happened to your home, your assessment, your exemptions, and your legal rights as a homeowner. They buried it. They buried it inside a spending package that the media covered for entirely different reasons. And while reporters were chasing the headline on the front of that bill, the back pages, the pages that directly affect what you owe on the home you've lived in for 30 years, went completely unexamined. That is the story. That is what we're doing today. Congress passed age-based property tax protections for homeowners born before 1970, and the overwhelming majority of the people those protections were designed to help have no idea they exist. That is not an accident. That is a system working exactly as it was designed to work against you. If you own your home and you were born before 1970, what I'm about to tell you is not optional information. This is not a lifestyle tip. This is not financial advice from someone trying to sell you something. This is the law. This is what changed. And this is what it means for your next property tax bill, for the value your county uses to calculate what you owe, and for exemptions you may have been legally entitled to for years. That nobody, not your county, not your state, not the media, ever bothered to tell you about. Stay with me through this entire breakdown, because whether you were born in the 1940s, the 1950s, or the 1960s, there are specific provisions that apply specifically to you, and at the end, there's one universal action, one form that every homeowner over 55 needs to file, and almost nobody has. If this channel is how you found out about this, that tells you everything about where the mainstream media's priorities are. Subscribe right now and hit the bell. I cover these changes the week they happen, not 6 months later when the deadline has already passed you by. Now let's get into it. Here's what I want you to understand before we go any further, because I know what some of you are already thinking. You're thinking, property taxes are local. My county sets them. My city sets them. My school district sets them. What does Congress have to do with any of that? And that's a completely fair and intelligent question. The answer is this: Congress didn't touch your local tax rate. What Congress changed is the federal framework, the underlying architecture that determines how your home gets assessed and what exemptions you are legally entitled to claim based on how old you are. Your county still sets the rate, but the assessed value your county applies that rate to the number your entire bill is built on is now subject to federal caps, federal freezes, and federal exemptions that flat out did not exist before this legislation passed. These protections are not income-based. They are not means-tested. There is no financial hardship threshold you have to cross if you own your home. If you live in it as your primary residence, and if you fall within the age range, you qualify full stop. Now, I want to talk about why you didn't hear about this, because that question matters as much as the policy itself. And the spending package this was buried in got enormous media coverage. But for other things, budget fights, political theater, the usual performance, nobody pulled out the section on senior homeowner property tax protections and said, hey, this directly affects tens of millions of Americans. Here's what it means and here's what you need to do. That didn't happen. And I'm going to be blunt about why. County assessors' offices across this country have a direct financial interest in you not claiming every exemption you're entitled to. Every exemption you leave on the table is revenue they keep. They're not going to proactively tell you that you've been overpaying. They're not going to call you. They're not going to send you a letter saying, by the way, here are 3 programs you qualify for that would reduce your bill. That is not how the system works. The system is built on your ignorance, and it has been profitable for a very long time. What changed this year is that Congress gave you legal tools to fight back. What hasn't changed is that no one is going to hand those tools to you. You have to reach out and grab them yourself. Let's start with the group that has the most urgent deadlines. Homeowners born in the 1940s. If you were born between 1940 and 1949, you are between 76 and 85 years old right now. You have likely owned your home for decades. You bought it when it was worth a fraction of what it's worth today. You've watched the assessed value climb year after year while your retirement income stayed relatively fixed. You've paid and paid and paid. Congress gave this group 3 specific protections, and the first one is the most sweeping change of all. The property tax freeze. For years, many states had senior property tax freeze programs that locked your home's assessed value so that rising market conditions couldn't keep driving your bill higher and higher year after year. Those programs existed. The problem was that they were opt-in. You had to know they existed. You had to find the application yourself. You had to fill it out and submit it to your county assessor. And the brutal truth is that most homeowners born in the 1940s never did any of that because nobody told them the program existed in the first place. Counties didn't send notices. States didn't run awareness campaigns. The information was technically available to anyone motivated enough to dig for it. And that was the whole point. What Congress did with this legislation is eliminate that barrier entirely. Every state with an existing property tax freeze program is now federally mandated to automatically enroll homeowners born before 1950 who own and occupy their primary residence. You don't have to find the form. You don't have to apply. The enrollment is automatic. Your home's assessed value is now locked at the 2024 level. It doesn't matter if your county reassesses your entire neighborhood next year and declares your home is worth 30% more. Your assessed value doesn't move, your bill doesn't spike, that protection is yours by law. Let me show you what this is worth in actual dollars, because this is not abstract. Take a home assessed at $250,000 in a state with a 2.1% effective property tax rate. That homeowner is paying $5, $250 a year. Now imagine the county, as many counties have been doing, raises the assessed value by 12% the following year. That's a $30,000 jump in assessed value. That adds $630 to the annual tax bill. And with compounding assessments over 3 years, that homeowner would be paying nearly $1,850 more per year than someone whose value is frozen. That's almost $1,850 a year, every single year for as long as they own that home, that the freeze saves them. And for the 7 states that don't currently have a freeze program, the federal mandate requires them to establish one by January 1st, 2027. So within 18 months, every homeowner born before 1950 in every state in this country will be covered. If you are in this age group and you have not received written confirmation from your county that your assessed value is frozen at the 2024 level, pick up the phone this week and call your county assessor's office. Tell them you were born before 1950. Ask for written confirmation that your assessment is frozen. Get a name, get a direct number, follow up in 30 days. If you don't hear back, this is not optional, this is money. The second protection for 1940s homeowners is the expanded homestead exemption. The federal homestead exemption threshold minus the amount of assessed value that gets deducted before the tax rate is even. Applied minus increased from $25,000 to $50,000 for homeowners over 75. This is a direct dollar-for-dollar deduction off the top. If your home is assessed at $250,000 and you claim the full $50,000 exemption, your tax is calculated on $200,000, not $250,000, at a typical mill rate that's between $525 and $1,050 in savings per year, depending on where you live. The form is at your county assessor's office. It's the homestead exemption application. And if you previously filed under the old $25,000 threshold, you need to refile under the new $50,000 threshold. Call your county assessor and tell them exactly that. And if you never filed the homestead exemption at all, ever understand what that means. You have been overpaying for years under the old threshold. That was $25,000 off your assessed value you never claimed. Under the new threshold, it's $50,000. At a 2% tax rate, that's $1,000 a year you've been giving the county that you didn't owe. 5 years of that is $5,000 gone. You cannot get those years back, but you can stop it today. The third protection for 1940s homeowners addresses something specific and serious: reverse mortgage foreclosures during benefit review periods. Many homeowners born in the 1940s took out reverse mortgages and also received VA benefits or Social Security. When federal agencies review those benefits, payments can be paused or temporarily reduced. And what was being allowed to happen is that reverse mortgage lenders were initiating foreclosure proceedings during those review periods because the homeowner's income dropped below the loan's occupancy requirements. Congress put a hard stop to that. The new provision prohibits reverse mortgage lenders from initiating foreclosure on any homeowner over 76 during an active federal benefit review period, whether that's a VA review, a Social Security disability review, or a pension recalculation. If you have a reverse mortgage and any kind of pending benefit review, send written notice to your loan servicer right now. State your name, your loan number, your date of birth, and cite the senior homeowner protection provision. Request written confirmation that no foreclosure action will be taken during your review period. Send it certified mail. Keep the receipt. Do this within the next 30 days. Now, let's move to homeowners born in the 1950s. Those of you between 66 and 75 years old. Many of you are freshly retired or standing right at the edge of retirement. Your home is your most valuable asset, and your property tax bill has been climbing faster than your retirement income for years. Congress gave this group 3 provisions, and the most powerful one is the assessment cap. Congress set a 3% annual cap on assessment increases for primary residences owned by homeowners between 66 and 75. To understand why this is significant, you need to understand what's been happening without that cap. In counties across this country, assessed values have been increasing by anywhere from 8 to 15% per year. Think about what that actually means. If your home is assessed at $300,000 and your county increases that by 10%, your assessed value jumps to $330,000. The next year, another 10% takes it to $363,000. In 2 years alone, your assessed value has grown by $63,000, and your tax bill has grown with it. Under the new 3% cap, that same home goes from $300,000 to $309,000 in year 1 and $318,270 in year 2. The difference after just 2 years is nearly $45,000 in assessed value, and that gap widens every single year. Over 5 years, the tax savings exceed $1,000 annually. Over 10 years, they can exceed $3,000 per year. Let me make that as stark as possible. If your county continues assessing your home at 10% annual growth for the next decade, a $300,000 home gets assessed at over $778,000. Under the 3% cap, that same home is assessed at roughly $403,000. That's a $375,000 difference in assessed value. At a 2% tax rate, you'd be paying $7,500 more per year than you should be. That is not a rounding error. That is a second car payment. That is a vacation. That is money that should be in your account, not in the county's. And here's the part that gets people. The cap is retroactive to January 2026. If your county already applied a higher assessment increase to your 2026 property value, you are legally entitled to a correction. To claim it, you need to file Form 1098-SR, the Senior Residence Assessment Cap Request, with your county assessor. The deadline is October 15, 2026. That is less than 3 months from the time this is publishing. You do not have time to procrastinate on this. Download the form from your county assessor's website or call their office and request it directly. Fill it out, submit it. If your 2026 assessment already exceeded 3%, a corrected bill will follow. This is a good time to pause, because if you are watching this and realizing you've been leaving money on the table, share this right now. Your neighbor, your brother, your parent, your friend, who was born before 1970 and owns their home, they need this information. Subscribe, hit the bell, and pass this along, because the people this affects most are the people least likely to encounter it through the mainstream media. The second provision for 1950s homeowners is the school tax exemption. If you're over 65 and receiving Social Security benefits, you now qualify for a school district tax exemption of up to $10,000 in assessed value. And critically, this stacks on top of the homestead exemption. It doesn't replace it. You get both. In states like Texas, Georgia, and South Carolina, school district taxes make up 40 to 60% of your total property tax bill. A $10,000 exemption on the school tax portion saves you between $400 and $600 per year, depending on your local district's rate. To claim this, contact your county assessor and ask for the senior school tax exemption application. You'll need a copy of your Social Security benefit statement, which you can download directly from ssa.gov. Once you file this exemption, it renews automatically every year in most counties. You do it once, it protects you indefinitely. The third provision is one that doesn't affect your annual tax bill. It affects the single largest financial transaction most Americans ever make. Congress added a $100,000 senior supplement to the federal capital gains exclusion for sellers between 66 and 75 who have owned their home for 20 or more years. The existing exclusion, $250,000 for single filers, $500,000 for married filers, has been the law for years. But home values have exploded since the 1980s and 1990s when many of you bought. The old exclusion simply hasn't kept pace. The new supplement closes that gap. As a single filer, your exclusion is now $350,000. As a married filer, it's $600,000. Here's what that means in real numbers. Say you bought your home in 1990 for $120,000. It's now worth $620,000. Your capital gain is $500,000. Under the old rules, a single filer would exclude $250,000 and owe federal capital gains tax on the remaining $250,000 at a 15% long-term rate. That's $37,500 to the IRS. Under the new rules, that same filer excludes $350,000 and owes tax on only $150,000. That's $22,500. The supplement saved $15,000 on a single transaction. If you are considering selling your home in the next few years, talk to your tax preparer about the senior supplement before they file your return. It's claimed on Schedule D of Form 1040 and requires proof of ownership, duration, your deed or original closing documents. Now let's talk about homeowners born in the 1960s. Those of you between 56 and 65, you are either approaching retirement or just entering it. You may still have a mortgage. Your property taxes are a serious line item every single month, and Congress gave your group something the other age brackets didn't get: the longest benefit horizon of all three. These provisions extend further into the future, which means the cumulative value they deliver is enormous if you act now. The first provision is the Deferred Payment Program. Congress created a brand new federal property tax deferral for homeowners between 60 and 65 who are within 5 years of their planned retirement. Here's the mechanism. You apply through your county assessor to defer your annual property tax payment. The deferred amount is not forgiven. Let me be completely clear about that. You still owe it. But instead of paying it out of your pre-retirement income right now, the balance accrues at 2.5% simple interest and becomes due when you sell the home or when you pass away, at which point it's settled from the estate. Compare that to what happens without this program. Most counties charge penalty rates of 8 to 12% on late or deferred tax payments. Some begin lien proceedings within 12 months. The deferral program replaces that punishing penalty structure with a 2.5% simple interest rate, which is lower than current inflation. If your annual property tax bill is $4,000 and you defer for 5 years, you've deferred $20,000 total. The interest over those 5 years at 2.5% simple interest is $2,500. Your total obligation is $22,500. Meanwhile, if that $4,000 per year had stayed in a conservative bond fund earning 5%, your opportunity savings over those 5 years are approximately $5,000 in returns you didn't sacrifice. And the net benefit of deferring is real, and it's meaningful, and this is not a debt trap. It does not affect your credit score. It creates a deferred obligation that settles at sale, not a traditional lien. Your home remains fully yours. You can refinance, make improvements, and leave it to your heirs who would simply settle the deferred balance from proceeds. This is a cash flow tool for the 5-year window when you need it most. The second provision for 1960s homeowners is the renovation tax credit. And I want you to pay close attention here because the distinction matters. This is a 15% tax credit, not a deduction. A credit comes directly off your tax bill, dollar for dollar. Qualifying modifications include grab bars in bathrooms, walk-in tubs, roll-in showers, wheelchair ramps, widened doorways, stair lifts, non-slip flooring, lever-style door handles, and first floor bedroom or bathroom additions. Modifications designed to let you stay in your home safely as you age instead of surrendering to assisted living or a nursing home. The maximum credit is $7,500, calculated as 15% of up to $50,000 in qualifying modifications. The average cost of assisted living in America right now is approximately $4,500 a month and $54,000 a year. A $50,000 home modification that keeps you in your own home for even one extra year more than pays for itself. After the credit is available for modifications completed between January 1st, 2026 and December 31st, 2028. You claim it on Schedule R of Form 1040. Keep every receipt. Keep every contractor invoice. Take before and after photographs. Get a contractor's written statement confirming the modifications meet aging in place standards. If you've been putting off bathroom upgrades or accessibility improvements, stop putting it off. The government is paying you 15 cents on every dollar to do it right now. The third provision is the downsizing incentive, a one-time $5,000 federal tax credit for homeowners between 60 and 65 who sell a home valued over $400,000 and purchase a replacement home valued under $300,000. The rationale from Congress is straightforward. Larger homes are in high demand from young families who can't find inventory, and many retirement-age homeowners are sitting in four-bedroom homes they no longer need. The $5,000 credit is available once per taxpayer for transactions completed between January 1st, 2026 and December 31st, 2028. You claim it on Form 5405S with your federal return for the year the purchase closes. But here's what I really want you to hear. The $5,000 credit is just the starting point. When you stack it with the expanded capital gains exclusion, the lower property taxes on a smaller home, the reduced insurance, the lower utility bills, and the reduced maintenance costs. The average homeowner who downsizes from a $400,000 home to a $300,000 home saves between $6,000 and $9,000 per year in total housing costs minus, before the credit, over 10 years of retirement. That's up to $90,000 staying in your accounts instead of going out the door every month. If you've been on the fence about making that move, run the real numbers. The math is almost always overwhelming. Now here's the part where everything I've told you comes together. And this is the action item that applies to every single person watching this, regardless of which decade you were born in. There is a form called the Senior Homeowner Tax Review Request. Most homeowners over 55 have never filed one. Most homeowners over 55 have never even heard of it, and I'm going to tell you exactly why that is. In 2024, Congress mandated that every county assessor's office in the country must accept and respond to a senior homeowner tax review request from any homeowner aged 55 or older. When you file this form, your county assessor is required by federal law to conduct a comprehensive review of every exemption, every freeze, every cap, every credit, and every deduction you are eligible for, based on your age, your income, your ownership status, and your veteran status, if applicable. They must respond to you in writing within 60 days. That response must include a complete list of every program you qualify for, the dollar value of each benefit, and the specific forms you need to file to claim each one. The review costs you nothing. The form takes about 10 minutes to complete. And the reason almost no one has filed it, because counties save money when you don't claim your exemptions. Every dollar of exemption you leave on the table is a dollar of tax revenue they collect instead. They are not going to send you a letter. They are not going to call you. They are not going to pull up your account, review your age and ownership history, and proactively tell you that you've been overpaying for years. That has never been how this works, and it's not going to start being how it works unless you force the issue. This form is how you force the issue. You go to your county assessor's website and search for Senior Homeowner Tax Review Request. In most counties, it's a downloadable PDF. You fill in your name, your address, your date of birth, and your property parcel number, which you can find on your most recent tax statement. You sign it, you submit it. If the form isn't on the website, you call the county assessor's office directly and you say these words: I am requesting a Senior Homeowner Tax Review Request form as mandated by federal law. They will know what you're talking about. They are required to provide it. Once you've submitted it, you mark your calendar 60 days out. If you don't receive a written response in that window, you call back and you reference your submission date, they are federally required to respond to you. Think about what this form actually delivers. You submit it, and 60 days later, you have a document in your hand, written, official, from your county, telling you exactly which programs you qualify for, exactly what each one is worth in dollars, and exactly which forms you need to file to claim each benefit. You don't have to research anything. You don't have to guess. You don't have to hope you didn't miss something. All you have to do is file the forms they list in their response. This form is the master key. And if you qualify for 3 exemptions worth a combined $1,200 per year, and you've gone 5 years without claiming them, that's $6,000 you overpaid. You cannot get that back, but you can stop it starting this week. Let me bring this all the way home, because I want to be clear about what I think this moment actually represents. Congress changed property tax rules by age. They did it inside a bill the media didn't explain properly. The people who benefit most, homeowners in their 60s, 70s, and 80s, people who've worked their entire lives, paid into the system their entire lives, built equity over decades, were given no real notification that these protections exist. Counties have every financial incentive to stay quiet. States have every bureaucratic reason to move slowly, and the media had other things to talk about. So here we are, tens of millions of American homeowners sitting on legal protections they can't claim because nobody told them the protections existed. If you were born in the 1940s, your action items are clear. Call your county assessor and confirm in writing that your assessed value is frozen at the 2024 level under the automatic enrollment provision. Refile your homestead exemption under the new $50,000 federal threshold. And if you have a reverse mortgage with a pending benefit review of any kind, send certified written notice to your loan servicer this week citing the senior homeowner protection provision. Your combined annual savings from these 3 actions can exceed $3,000 a year. If you were born in the 1950s, download and file Form 1098-SR with your county assessor before October 15, 2026, to lock in the 3% assessment cap. That is your most time-sensitive action item, and the clock is already running. Apply for the school tax exemption by filing the senior school tax exemption application with your county assessor. And if you're planning to sell your home, talk to your tax preparer about the $100,000 senior supplement to the capital gains exclusion before they file your return, and make sure it appears on Schedule D. If you were born in the 1960s and you're within 5 years of retirement, contact your county assessor about the federal property tax deferral application if you're planning any aging-in-place modifications to your home. Get them done before December 31st, 2028, and claim the 15% credit on Schedule R. That's up to $7,500 directly off your tax bill. And if you're considering downsizing from a home over $400,000 to one under $300,000, file Form 5405S with your federal return and collect the $5,000 credit Congress created specifically for that transaction. And no matter which decade you were born in, file the senior homeowner tax review request with your county assessor this week, not next month, not when you get around to it. This week, that single form triggers a legally mandated, a comprehensive review of every property tax benefit you are owed. It takes 10 minutes, it costs nothing, and it forces your county to put in writing exactly what they owe you and exactly what you need to file to. Collect it. You've been paying into this system your entire adult life. These protections exist. These exemptions are real. The only thing standing between you and the money you're owed is the action you take in the next few days. If this is the first time you're hearing about any of this, if this is the channel that finally broke this down clearly for you, then you already know what to do next. Subscribe right now. Turn on the bell. Share this with every homeowner you know who was born before 1970, because this is the kind of information that changes what people actually owe on their homes, and it deserves to reach every single person it was designed to protect. The system isn't going to advocate for you. That's what we're here for.